Hello, and welcome back to day 2 of the 7th annual Oxford Economics of Mutuality Forum. We're so glad to have you here. Good morning, good afternoon, good evening from wherever you are joining us around the world. This forum is about confronting systemic crises, and we're talking about and exploring ways to motivate, equip, and partner with business to deliver practical solutions. Our programming and exploration today will turn to the role of regulators, standard setters, and investors. And we'll be digging into some of the topics about the targets that companies should be setting, and then how we should go about measuring, managing, and mobilizing to drive systemic transformation. Our aim is to bring you a wide range of perspectives and to explore these topics so that we can all figure out what our own role is in accelerating these change. To get us started, I'd like to welcome Colin Mayer back to our stage. He is the former dean of Oxford University's Saïd Business School and a visiting Oxford professor. Today, he'll be delivering some introductory remarks on our theme. Welcome, Colin.
Thank you very much indeed, Amanda, and thank you to all of you for joining us. And I'd just like to start off by saying how sorry I am that I'm not doing it as I have done for the past 7 years in conjunction with Bruno Roche, who's always been my collaborator in introducing the forums, but very unfortunately, he's unable to be with us this year, and I'd like to wish him all the best. We recognize that capitalism is one of the most important systems in our lives. It clothes, feeds, and houses us, it employs us, and it invests our savings. It's the source of economic prosperity and the growth of nations around the world, and it's also been the source of the elimination of a lot of poverty around the world. But at the same time, it's been a cause of growing environmental degradation, inequality, social exclusion, and crises. If you look at the number of references to the words crises and capitalism, since the beginning of the 20th century, they've increased significantly. But put the two words together, crisis and capitalism, and look at references to when they are referred to together. And you see that it goes up very rapidly since the 1960s. And since the beginning of this century, it's gone through the roof. And furthermore, the word polycrisis, which we might associate with events that have gone on over the last few years, in fact began to appear around the time of the financial crises. There's been a sudden recognition of an association of capitalism with crises. Why is that the case? Well, one of the main drivers that we believe is the cause of this is the very nature of business itself. A nature of business which has increasingly, since the 1960s, been associated with one objective of business, and that is to make money. And that notion of the purpose of business has been a driver of both its remarkable and growing success and its remarkable and growing failures. And of course, there's been an increasing recognition of that, and we've mapped that out through various previous fora in this series. But what has become increasingly recognized as well is that the notion of there being purposes beyond just profit have not gained sufficient traction. They really haven't been embedded in the way in which it was hoped a few years ago that they might have been, in the form of purposes that go beyond profit. But what has also happened recently is a notion of what it really means for a corporation to have a substantive purpose. And that notion is around it having challenging, meaningful purposes and objectives. And the one that is particularly pertinent is the notion of a purpose of business as being about solving problems that you and I face as individuals, societies, and the natural world. And in particular, to think about how to solve the problems associated with crises and avoid them happening in the first place. But business has to be able to do this in a way that achieves a particular outcome. And that is, it has to be commercially viable and profitable. So the relevant notion of what one means by a meaningful challenge is that it's about producing profitable solutions to the problems of people and planet, not profiting from producing problems for either. Now, that's not vague or woolly. It's not about philanthropy or charity. It's about hard-nosed business. It's not even about corporate social responsibility or ESG. It's about what problems a company is there to solve, for whom, when it's going to solve them, and how it's going to solve them. And that notion of it having to do so in a form that is profitable lies at the heart of why business is such a powerful way of being able to address that, because of the resources and the incentives it creates in the process of solving those problems. Now, to do that, there first of all needs to be a strong element of credibility associated with the company's notion of that problem-solving purpose. It has to bring real clarity to it as to what those problems are it's seeking to solve. It has to connect that problem-solving purpose with its strategy so that it really is core to what it does on a daily basis. It has to ensure that there's a real ownership associated with the purpose in terms of a commitment by those who own, invest in, are shareholders of the firm, but also a real commitment by everyone in the organization, from the top, from the board, to the shop floor. Everyone needs to feel and understand their role in contributing to the corporate purpose. There has to be a close alignment in terms of not just the culture and values of the organization, which are critical to ensuring that people really do feel a sense of ownership of the company's purpose, but also in terms of the way in which it measures and rewards people and incentivizes them and ensures that those are aligned with the delivery of the company's purpose. And it has to be able to bring that purpose to life through narratives that demonstrate how it's really succeeding in achieving not just the profit, but also the problem solving and the challenges and the difficulties it faces, as well as the successes in so doing, because authenticity is key to making a purpose meaningful. Now, we had a wonderful illustration of this yesterday in the interview I did with Paolo Lanzarotti, the CEO of Acacia, in which he talked about how Acacia has identified its purpose as being around creating connections, meaningful connections of people in the societies in which they operate. And that notion of meaningful connections and creating those connections has allowed the business to transform its understanding of what it's doing. It's not just producing beer or beverages in general. It's producing a way of creating social capital. And that social capital then creates a form of asset for the company, which goes well beyond just selling beer, but also as being seen as playing a key role in the societies within which it operates. And Paolo described how they really have embedded that in the organization, in the company, so that it is part of the strategy of the business and the way in which everyone in the business connects with it. And how they've created a system of measurement and rewarding people so that their incentives really are aligned with the delivery of that purpose. So it really is a form of not only solving problems, avoiding crises, but delivering benefits to companies and their investors as well. Now, there's a second part that I mentioned in terms of that notion of the purpose of the business, and that is around not profiting from producing problems. And that's a key additional component, because not only does that then gives real substance to what is a valid or justified purpose, but also what is a just notion of profit. It means that there is a sense of a just profit as being associated with the delivery of solutions, not the creation of problems. And in other words, that profiting from creating problems for others is not really value creation or wealth creation. It's value diversion. It's transferring wealth and value from one party to another. And that's not the basis of a true profit of a company. So purpose is important, not just in thinking about how does one motivate and strategize around a company, but also what should we be doing in terms of measuring the real driver and resourcing of business. And that is to say, the way in which we measure the profit of a business. And if one thinks in those terms, then one suddenly realizes the power of this notion of a corporate purpose, because it's not only a driver of a strategy of a business, but it's also a way of connecting a business with the system in which it operates. One begins to realize that what is needed to really address the problems and the crises that we face is to recognize this as a systems change problem. That we're not revolutionizing the way in which we're operating the capitalist system, but we are recognizing its deficiencies and the needs to transform it in such a way that those deficiencies are effectively addressed. And that means that one has to think about the components, all of the components associated with a capitalist system that are required to do that, in terms of the laws and regulation around corporate law and financial regulation, corporate regulation, and all the other forms of regulation that go with that. One has to think about the nature of ownership. What does it mean to own a company in this context? It's not just about the ownership of the assets. It's not just a property right, as it's sometimes thought about, but it's a responsibility. It's a responsibility to the system in which the firm operates and all the parties of that system. You and I as individuals, our societies, our communities, the environment, the natural world. A business is part of that system, and it has a responsibility to contribute and help to solve the problems, not to create the problems of that system. And it means thinking about what leadership of an organization means, what governing a company requires in terms of engaging everybody and motivating everyone in an organization to recognize that they are there to help solve those problems, to think about how Asahi can make meaningful connections within the societies in which it operates and help people to feel included, not excluded, if for some reason or other they don't want to drink an alcoholic form of beer. And how does one think about aligning the way in which we measure and incentivizing people in organizations? It means that we're not just measuring the inputs and the outputs of companies, but the changes that those companies bring about, the outcomes, as it's sometimes termed, and the impact that the company has through its purposes on others, and ensuring that it is not profiting from creating problems. And this relates to the role of those investing in companies, investing in helping to ensure that companies have the resources that they need to be able to solve problems profitably, and that they are overseen and stewarded by investors who assist them in the process of solving those problems. And it's about investing in partnership with others, not just in the private sector, not just with other companies, but with those in the social and philanthropic sectors, and in particular in the public sector, because business on its own cannot solve the problems that we face as societies around the world. Now, that notion of a capitalist system as being a system of solving the problems that we face as individuals, communities, and the natural world, then lends the basis on which one can think about how business going forward can be a real powerhouse for driving change and driving solutions to the problems that we face. We need to think about this in terms of bringing together all of the components around law, regulation, ownership, governance and leadership, measurement and performance, as well as the way in which financial investors and governments interact with business. We need to think of this as a cooperative systems challenge that we are capable of solving, and we must solve as a matter of urgency, because we've reached a point at which we face crises that threaten not only our survival, not only the existence of our communities and our natural world, but the very political systems and the democratic system that underpins it. We are placing too much of a burden on government to try to solve problems without business and those associated with investing and running businesses in ensuring that they too are contributing directly to solving those problems. Because at the end of the day, this is a moral dilemma. It's a moral dilemma as to what we really see as being the meaningful and valid purpose of businesses. Because ultimately, a morally based capitalist system is one that is a competitively successful and socially acceptable form of capitalism. And those countries that have morally robust capitalist systems are the ones that will successfully compete in the world around them for the benefit of the many, not just the few, for the future as well as the present. Thank you. I think you're on mute, Amanda.
Thank you for that. Thank you. I was saying thank you so much for your wonderful distillation of what we really want business to focus on and how to help us get there. You had a lot of comments coming in with appreciation. We will see you later on in the forum. Thanks again. I'd like to welcome to our stage for the next part of the program. We will be having a fireside chat conversation. We will be welcoming Gavin Long, who's the Executive Director of Economics of Mutuality, as well as the co-founder and partner of Acacia Group, in conversation with NADIA TERFOUS, who is our Managing Director at EOM Solutions, as well as a former partner at McKinsey & Company. So I'd like to welcome Gavin and NADIA. And I'll turn it over to you now, NADIA.
Thank you very much, Amanda. Good morning, good afternoon, and good evening to all. I'm very pleased to welcome Gavin Long. Hello, Gavin.
Morning, Nadia.
We will be discussing the role of investors to drive systemic transformation. Let me first make Gavin introduce you properly. So you have more than 20 years of experience in corporate finance and transactions, and you have a very strong experience in providing tech solutions. You co-founded the Acacia Group that Amanda was referring to, a PE investor backed by ultra high net worth US families. You are a partner at Acacia and you acted as CEO for two of the portfolio companies. So you have both, I would say, the investor experience, but you also have the operational experience of transforming companies. And you have recently joined the Economics of Mutuality as executive director. And you've been following the Economics of Mutuality for quite some time. And you worked with the Economics of Mutuality as a client. So let me maybe first ask you a question that is more of a personal question around, what has been driving you throughout your career and your life? What is and has been your purpose all along?
Yes, thanks, Nadia. And by the way, apologies for the background. I had a computer crash. So Thanks for the grace. My history and my background began a little bit from an unorthodox position. I actually was attending seminary for the goal of actually pursuing something for the common good, driving me from the very beginning. And I accidentally fell into corporate finance when I didn't know what a balance sheet was, and I heard of Goldman Sachs. And I worked with Arthur Andersen Corporate Finance in the technology and software practice, and did that for several years. And I would say the tension that grew for me, at least, was really enjoying and being a part of the financial services, the capital deployment landscape, the engagement with companies. I ultimately ended up working with a large private equity group, forming investment theses for them, and being operationally engaged and engaged in the day-to-day business. But I felt that there was a disconnection from actual societal or environmental impact to doing something for the greater good from capital deployment. And in fact, I ended up advising a very large private equity group that I watched really systemically erode value in a business, and actually still produce good returns for its investors, but it was actually doing damage to the business that it was invested in. And so it sent me on a journey to reconcile this desire to do something that was impactful for society, that was contributing for people and planet. And it wasn't until 2013 that I actually encountered Economics of Mutuality. And upon reading that, an article in the Brewery Journal, really coming alive with the idea that the marketplace and investment can be an agent for the common good. And as you mentioned, I began my own private equity firm with my two partners that we co-founded in 2016. And in that journey, I actually became a client of Economics of Mutuality, and met with you and several of the other EOM practitioners around what it might mean to leverage private equity and, candidly, other forms of investment classes to really be transformative for societal impact.
Thank you, Gavin. So if I hear you, you do believe that finance should be obviously at the service of people and planet. I mean, I think some people wonder whether finance should, fill the void and actually contribute to solving global challenges. So I guess my question is, do you think we can rely on investors to accelerate the move towards a better world, which goes way beyond, like we've been saying yesterday and today, beyond just minimizing harm? We're talking really about creating net positive value.
It's an excellent question, Nadia. And I will say I'm deeply committed to the idea that finance has a responsibility.
Gavin, I lose you a little bit. You cut from time to time.
Can you hear me now? I'm sorry.
Yes.
I said I'm deeply committed that finance is responsible for creating for its society, for the environment. So with that, really, business, their operations follow the demands and the drivers of their equity investors, whether it's a publicly traded entity or whether it's the LPs and the GPs in a privately traded entity in private and public equity or in venture capital. And therefore, I think the way that investors think drive ultimately the behavior of the business. And I think, as we're watching the polarization of ESG, it's an opportune time for us, particularly what we're doing with the Economics of Mutuality, to say, yes, absolutely, finance has an important role and actually has a mandate to be driven by the common good and by societal and environmental impact. And we can't be given over to the last 50 years of where we're just purely driven by shareholder value. It will continue to create more exploitive and commodified approaches that ultimately do damage and erode trust. So I think now the second part of the question is, should we rely? The investors are still, in all candor, I think it's still very early. There's very much a disposition for the maximization of shareholder value is the mandate for finance professionals. The good news is, having been out in the LP landscape quite a bit of late within equity raises we've conducted, I'm seeing much more of a drive from limited partners to be driven and to be systemic in their approach toward impact. So, and that's not just impact funds, traditional funds that are actually looking to be more responsible.
Thank you, Gavin. And if you look at the current situation, and obviously that triggered my question, I mean, if you look at the global ESG, let's call it sustainable or ESG related assets under management, we're talking about 30 to 40 trillion dollars, about 1/3 of the total AUM globally. But obviously, well, first the numbers vary because obviously it's an assessment in the end of what is ESG related. And then the reality of the ESG related varies, I would say, widely. And there is obviously a lot of suspicion of greenwashing. So I know obviously that regulation starts kicking in some geographies like Europe, but there is also some I would say, organizations that kind of put in place some definitions of what ESG investing should look like. I guess my question is really, how do you think, are you optimistic about the ability of the investment world to come up with an approach that reconciles the need for societal impact and the need for returns, and again, move away from just doing less harm in the best case?
Yeah, so I still think it's early days, and candidly, obviously, that's one of the premises of this conference and what we do on a day-to-day basis. The problem that I have with a traditional ESG mentality is it's really not connected to the operation, nor to the ecosystem of the business. And ecosystem obviously is a word that we use frequently with respect to the economics of mutuality. And we've seen case after case of someone meeting a standard or being able to, I'll call it in a two-dimensional way, meet a criteria of ESG and say diminish, something that they're doing that would be considered anti-ESG in exchange for doing something that's just exploitive or commodified in another area. And so that's ultimately just shifting the problem from one place to another, but still yet meeting the ESG criteria. So I'm clearly very optimistic that there is an investment model that really isn't a trade-off model. It's not, here's a cost center that let's put some cost and let's do some less harmful things and maybe some corporately, socially responsible things, but there's actually a way to look at your ecosystem, identify impact areas, look at value creation opportunities, and ultimately drive value and reduce risk within the investment cycle and investment thesis that's still contributive to the common good and to the greater societal and environmental benefit, but yet not curtailing returns for investors.
So now it's very interesting, and let's dive then deeper into what that investment model would look like that you started describing in terms of the typically the ecosystem being also at the heart of the consideration for this new investment model. Can you tell us typically how investors could allocate capital differently to start with? So what could be the deal sourcing strategy, so the pre-investment phase, what should it look like?
So we have very practical examples, as you know, in that we're actually working on a transaction right now and working on setting up, in essence, a fund around, we've identified a particular impact area. And we are actually beginning the investment thesis with prioritizing the areas of impact. And so we've done a big data screen with the help of Economics of Mutuality. And we've actually looked and prioritized impact areas and then conducted our M&A screen according to those impact areas. Then from that point, identifying companies and beginning to have discussions with those companies around the impact areas and let those impact areas and meaningful challenges really drive the strategy, not only of the initial platform acquisition, but also the expansion of those impact areas as we further the investment thesis. Now, one of the things that in practice that we've done in this process, in this deal process, is actually looking at the capabilities of the business, mapping the capabilities of the business to those impact areas, and literally doing the ecosystem work to identify areas of value that may be untapped. NADIA going as far as actually putting it in our leverage buyout model of identifying new revenue areas where we can identify impact areas, put budget accordingly to it, and actually demonstrate that there's revenue and gross profit to be had by understanding some of the places of meaningful challenge in the ecosystem. So we've taken kind of an outside in approach, looking at the broader sector by way of the mutual value initiative, prioritizing our M&A candidates as such, and then we're literally letting that drive our investment for the initial platform of the deal that we're working on.
And I guess, Gavin, that allows you both to see if the investment is worth it from a value creation perspective, societal value creation perspective, beyond obviously the financials, but also what the societal value creation will trigger in terms of financial returns, right?
Absolutely. And I think another thing to note in this is we're treating, I'll call it, an economics of mutuality lens as a lens for all diligence streams, whether it's financial, legal, commercial. But in addition, we actually conducted an impact diligence report so that we could actually get comfortable with the fact that we believe this investment could be of positive benefit societally before we ever deploy the capital.
Is that also a way of creating an alignment with the investors, that they know what you aim for at?
And it's interesting. A few years ago, some of the large asset managers made the statement, we've got LPs, and therefore we have to be responsible from a fiduciary point of view to those LPs. We can legitimately say, not only are we being fiduciarily responsible, but we're aligning impact and societal value creation at the beginning of a process, into the raising of funds, so that when we launch into the investment, we're in alignment with LPs. And then, as you know, Nadia, we've taken one step further, and we've actually created digital dashboards to actually measure those impact areas so that we can report them back to the equity investors. And actually, interestingly enough, in this case, with the transaction to platform deal that we're working on right now, also to the debt investors. So the lenders are actually looking at those impact areas, and we're involved in the alignment from the very beginning of the acquisition.
And Gavin, so you've talked about the sourcing strategy, and you've also talked about the measurement, because at some point, once you have aligned on these value creation drivers, as you said, you need to measure, track, and report them. Let me ask you a question around, what else should investors think about, either in terms of stewardship, if they don't have the ability to really transform the company itself. So what should they do to improve their behaviors and make them more consistent with societal value creation?
Well, I'll say selfishly, from an economics of mutuality point of view, I think we're trying to offer some tools broadly to be able to empower that stewardship. Sometimes I feel impact investing, or investing that's really driven by societal impact or the common good, is left in some respects to intuition of the investors or the operators. And so I think there are some methodologies that can be used: this outside-in approach, the screening approach, this reporting approach, this intervention approach that we've discussed, of identifying meaningful challenges and creating those KPIs. And by the way, that's not just for societal impact. The wonderful thing and the reason I'm so passionate about the economics of mutuality and the approach, is it actually provides investors and senior executives with the ability to see leading indicators by way of human capital, social capital, and natural capital. So it's actually giving operational metrics to help transform that business, but also, for investors, getting early identification of potential areas of weakness within the investment is absolutely critical and imperative. And so the more you can use those leading indicators in human, the social, and natural capital, I believe it's providing great visibility to operational leaders and to investors. And I think those kind of tools, again, whether it's from an economics of mutuality point of view or whether it's another lens, I think investors having a drive to actually see those areas and report to those areas and manage to those areas is not just societally beneficial. It's actually, from an investor's point of view, beneficial to be able to see how the company's actually performing.
It's very interesting because these early indicators that you're talking about, these leading indicators that you're talking about, are both leading indicators of societal value as well as business value, ultimately, right?
And if you can see erosions of trust early in various areas within your ecosystem, it's giving you at least an inkling of something's going on with that ecosystem, within that ecosystem that should be addressed. And it's either a value creation opportunity or a risk mitigation opportunity, or in some cases, maybe both.
Yeah, very well. And the thing is that most investors are doing, I would say, pretty well, I guess, in terms of risk mitigation, right? But not so well in terms of identifying what can be a driver of returns and impact and societal impact.
That's right. And I really believe, and part of the premise, I think really some of the roles of control investors, and I think it can be done across the board. It's not just control investors, but a control investor that's really trying to produce, superior returns for their limited partners, I think really have a unique opportunity to tell not only a positive societally and environmentally impactful story, but to legitimately say this is a new area of being able to earlier through human, social, and natural capitals identify areas of value creation that maybe historically wouldn't have been seen.
Now, I'm wondering, Gavin, and that's very much, I think, of a new approach. I think it's really I would say the next horizon for the investment space. My question would be, what should we do to allow investment to become a driver of change globally? So how do we get this new approach embedded in the way investment practices are in the way investment is done, basically? So I'm looking into the levers, if you want, to accelerate the transition of the investment world. Is that we were talking about dashboard? Is it about improving the way we measure outcomes and we report on these outcomes? Is it? I mean, regulation again is difficult to control. It's coming and it's going to increase probably. But how do you see the change happen over time, and what would be the triggers for the change to happen?
I think, not to be redundant, but I think the way we look at the sectors or the industries that we're pursuing to deploy capital, and not limited to kind of a traditional market study that's a little bit two-dimensional between kind of vendor and potential customer and where the dollars are, but seeing value creation opportunities and a broader understanding of that ecosystem by identifying those impact areas, by prioritizing the problems of people, place, and planet, like we've talked about, for years. I think a more three-dimensional or holistic view of the sector or the industry is a wonderful place to begin. Because if you can begin there, it not only helps you reshape the way you source, it also reshapes the way that you develop the investment thesis. And I think that's critical. I think additionally, though, really, and we have, and I come from a digital transformation background and a technology background, and Nadia, I know you know how important that is to me. I think we have unique advantages today that we didn't even have, 3 to 5 years ago, with data science capabilities that allow us to get insight into these ecosystems, into the operations of the business through advanced analytics and data science. And so I think with that provides us an opportunity, to your point, about using these tools, whether it's an ERP class dashboard that a CEO or a CFO can actually use to gather that data and measure to those areas. But I think the ability to use those kind of analytical capabilities and report that not only at an operational level, but back to the general partnership, and then ultimately back to the limited partnership, or back to the equity analysts, or back to the family business owners, like those kind of data science capabilities, I think provide a unique opportunity for us to advance the cause and how we think about societal impact and environmental impact within our investments.
And I guess, Gavin, the data science that you're talking about is also about building proof points that basically you can combine both, right? And that one can even be actually, a driver of performance. And I know, obviously we know it's important for investors, and that makes sense. But it's really, instead of basically remaining in the logic of trading off, doing some trade-offs between societal and financial value, if there is a way of proving that both can be reinforcing each other somehow, because also the more you generate financial value, the more you are able to invest potentially in the ecosystem. So that would be highly valuable, I guess.
Absolutely. I believe that kind of unique insight is really the next generation of investing, is really what we're talking about. Because I think historically, at least from a private equity context, it's largely, yes, there's some strategy or thesis development, but largely measurement has been almost purely financial, and pure financial measurement is almost entirely a lagging indicator. It's very difficult to get those leading indicators. And I think using these kind of analytics actually provide an incredible opportunity for investors to see things more clearly, to understand more holistically how the business is performing, and see opportunity candidly we haven't seen.
Do you think that's also a way of basically aligning, creating an alignment between, the investors, the senior executives, the employees, and I could say society at large?
Absolutely. And I think that alignment from beginning to end is really critical. As mentioned earlier, I think it's one of the things that over the last few years has been mentioned from an investor's point of view is, at the end of the day, investors are fiduciaries, and that is entirely true. And so this is a way, both at the beginning of investment theses and at the end of investment theses, or throughout the investment thesis, to make sure that alignment is intact. And I think that prevents situations like, there were pension funds that ultimately ended up having lawsuits because of ESG, or impact-driven approach, because ultimately, the pensioners were concerned that value was being lost. If we can ensure that alignment and align value creation with social impact, and I truly, for those listening, I don't think it's just empty theory. I think we're proving in real life that, in real investment opportunities, that this indeed can be the case. I think that alignment is absolutely critical to this next generation of how to think about investment opportunities.
Yeah, and you were referring obviously to what is happening essentially in the US in certain states, but I guess it becomes very much of a philosophical question, between the fiduciary duty and the societal duty. So again, if we manage to say there is actually no choice to be made, they both reinforce each other, it allows everyone to go beyond this philosophical question of what should we maximize, basically.
Absolutely. It moves past the philosophy and gets into the practical operations and investment mechanics of the business and of the investors. And I think once that conversation moves from philosophy into praxis, then we've got a completely different game.
I have a last question, and I will then take a couple of questions from the group. So my last question, Gavin, is if you had a wand, and with the wand could change things, what would you want to see in the investment practices, or how would you maybe characterize success? What you think is the adoption of this new investment model, basically?
I think if I had a magic wand, I would wave it over maybe some of the more traditional investment houses, some of the larger, both public equities and private equity investors. In other words, no longer is societal impact relegated just to the impact funds or the funds that are just dedicated to societal impact. But if I had a magic wand to wave, it would be over the household names and over the larger groups to really say, here are verifiable, practical, operational, and deal from a deal origination point of view, from an alignment with LPs point of view, ultimately to a deployment of capital and to a reporting both to GPs and LPs or to equity analysts that there is an opportunity for an adoption of a lens, and not only just a theoretical lens about how to deploy capital, but real tools that they can use not only to align themselves with the fiduciary aspects of being an investor, but with societal impact. And so I think my greatest hope and my greatest longing about, ultimately being with the Economics of Mutuality and being driven by this approach is that impact's no longer driven to a bespoke fund, that every investment group can be a participant in driving for societal and environmental impact and for the common good.
But by the way, and I know I stopped then. By the way, do you think there is, because obviously investment is a big word, I would say, made of very different types of investors. Do you think there is one type of investors that is more likely to move quickly? And I know you come from the PE, so you may be biased.
I've been biased towards private equity largely because of its control position. So as a private equity sponsor, at least from a buyout point of view, it's a lot easier to begin to move into an area and say, this is how we're going to operate the business. However, as you and I have been working collaboratively on other initiatives, I'm really heartened to see large asset managers think about in public equity context, who are usually meaningful shareholders, how to really push into societal and environmental impact areas. So I think, in short, private equity is a wonderful place to start. I probably am a bit conflicted and a little bit biased in that statement, but I think the good news is, this Economics of Mutuality approach is really asset agnostic. If there's any kind of deployment of capital or any kind of governance that an investor can come with, there's an opportunity to employ this, because once again, it's not just compliance or regulatorily driven, it's value creation.
Thanks. Let me, someone says, I'd love to hear the specifics on why there is so much pushback and how to have a conversation with those who oppose that on the polarization of ESG. And how does EOM differ greatly from stakeholder CAP? Has anyone from EOM had a robust debate with those that oppose EOM? And if so, is that recorded? So I guess it's maybe to get back to the theme of polarization of ESG. Do you have any sort of reaction to that, Gavin?
Yeah, I have an initial reaction, and as you can tell by the accent, I'm an American and I'm located in the U.S. Although I do invest globally. At least from the United States point of view, ESG is we're almost witnessing it be politically polarized, and we're even seeing ESG emerging in the political schema. I think that's early, but we're going to see that play out probably over the next couple of years, of where there will be political groups that will resist it, and there will be those that will advocate it, and it will actually continue this trajectory toward fracture. I think the driver behind that is a couple of things. I think from an ESG point of view, if it becomes regulatory oriented, there's going to be big resistance. At least again, from an American point, that's definitely the pushback from additional regulation. And this is one of the reasons why I think having a value creation approach, as opposed to a compliance and regulatory point of view, is really important, in all candor, to bring some unity amongst kind of, if you will, the left and the right, that can be commonly driven by the societal and environmental impact. So I think we're seeing it early. I think a lot of it still all goes back to, people grab a hold of ESG narrative, or they deny an ESG narrative because people haven't been able to correlate it to real operational change. And I think until we see businesses operating and behaving differently, not just having small cost centers for social responsibility or doing less harm, I think that polarization is only going to continue.
Thanks, Gavin. There is a question that is a little bit similar, but I still think it's an important question. Financial institutions find it hard to balance competing interests. They are tempted to prioritize calculations of measurable NPV versus choices offering long-term uncertain creation of value. Can we explain why this happens? And can we show that what leaders could do differently?
It's an excellent question. And I'll say, interestingly enough, though, investors are not without precedent of actually thinking about CapEx on the front end of creating value, or like pursuing value, and then investing on the front end and seeing that value created over longer terms. As a software investor and a technology investor, that's what you do every day. There's a crazy large industry that's just dedicated to that kind of CapEx behavior, not just relegated to software. It's in other industries. Isn't it interesting that we struggle with thinking about value creation by actually thinking about how we invest higher on the human capital or social capital basis? And this actually gets into an idea that we discuss in putting purpose into practice around the mutual P&L, of where if we think about those as initiatives and actually measure them and see how we can create value over the course of time, I actually think it's a compelling value proposition for investors, but it does change the way you think, at least about the management P&L. And I think there's an opportunity there. But my argument would be investors have thought about that historically in other areas with respect to intellectual property and the capital associated. I think we should appropriate that same discipline in the human and social capital.
There's a question around how to create the leading indicators. So the person refers specifically to social capital, but I guess, it could be in social capital, it could be in other forms of capital, these leading indicators. The point that is made is that obviously the idea of value differs across culture. Maybe you could explain a little bit the logic of this understanding of the ecosystem, and how do you basically highlight what forms of capital are missing, or could be improved in a given ecosystem?
I think that ecosystem lens is the key. That is the heartbeat to actually understanding where those opportunities are, through both a combination of secondary and primary research within the ecosystem, driven by purpose, by the way. So if a company is operating in a purposeful way and is kind of dedicated to meeting a need of people, place, or planet, then looking at that ecosystem associated with that purpose, we've seen it identifies those areas. Again, we have a rigorous methodology that's driven by both primary research within that ecosystem, and I'll call it even sentiment analysis within the secondary research. In identifying those areas, that's where some of those, not only we call them meaningful challenges, come from, but that's where we ultimately create these KPIs, and then ultimately prioritizing those KPIs. And let's just be honest, every company cannot address every single issue within an ecosystem, but prioritizing the areas that can be met, making those your KPIs, and then measuring them. One of the things that we're doing is measuring on a monthly basis, reporting on a quarterly basis, and then ultimately taking those KPIs and using them to continue to develop our strategy. I do think it is relevant to that sector, to that industry, to that geography, and ultimately to that company. So it's very particular, but it also is outside in and relevant to the impact of that sector.
Thanks. And some ecosystem analysis can be very contextual. So obviously some are relevant across, I would say, in the world. But some, I would say, some pain points or some unmet needs that will be very specific depending on the ecosystem.
Absolutely.
And there is, let me take another question. To what extent does a company face social and financial trade-offs when transitioning from a sole focus on on profit maximization to pursuing social goals as part of their purpose?
So if I understand the question correctly,
I guess it's again the question of the trade-offs, you know, to what extent there is trade-offs, and you can really, as you sort of pursue your purpose, still, you know, generate profit, enough profit somehow.
Yeah, what we're really philosophically and operationally committed to is moving away from the trade-off space.
Yeah.
And by the way, that doesn't mean that there might be areas of upfront investment, back to the previous question, but using that upfront investment to intervene in those areas of meaningful challenge, when we've looked at impact through the lens of creating value, I think provides us with a unique opportunity. Yes, from a budgetary and an operational point of view, there are dollars that are going to need to be spent. Our argument is those dollars spent are actually going to produce value creation opportunities and risk mitigation that will ultimately create a more resilient business. And in doing so, I mean, as investors, we all know growth and predictability are the two major drivers for valuation creation. And so if you can actually use the CapEx or the investment areas associated with addressing those meaningful challenges, we don't see it as a trade-off, we see it as an investment. And that investment creates value over the course of time.
And I guess, Gavin, because I was going to ask you, how difficult or easy do you think the transition from one, I would say, short-term, financially driven model to a much more complete and model, how difficult is that transition? But I mean, some do it because there is a leap of faith, but I guess what you want to do, what we want to do, is to show that with enough proof points that it's not a leap of faith. It's actually something that's real.
That's right. So without relying too heavily on my theological background that I mentioned earlier, it's a worldview, it's a lens, but it's also a pedagogical question. And what I mean by that is what we're not asking for CEOs, senior executives, and investors is to come to some wholesale philosophical change and wake up the next day and go, oh my gosh, I've got to change my entire organization. We're actually from a pedagogical, from an operational management, saying we can begin very simply and very tactically and demonstrate in the actual operational performance of the business and these change managements and the way we look at these leading indicators of human, social, and natural capital, that we can discover that this lens, and I think it's Paul that's asking this question, excellent question, because we are struggling with, in essence, a worldview or a lens issue between historic financial capitalism and the way we're thinking about a more complete version of capitalism. And I think the best way to discover a new approach or a new view is actually in vivo, in life, right? Actually doing it and experiencing it, not just coming to a philosophical conclusion and waking up day and going, oh my gosh, how do I change, you know, this multi-million or multi-billion-dollar operation that I'm a part of, or how do I change, you know, these billions of dollars I have to deploy? I think this change can begin actually very simply in the heartbeat of the day-to-day operation.
So data can somehow bring people together towards, towards the adoption of a new investment model somehow.
And wouldn't that be wonderful where data could actually people together as opposed to polarize them, as we
Thank you so much, Gavin. I really want to thank you for your thoughts, for your insights, and I do think that you've highlighted the fact that investors are a major stakeholder for the world to accelerate the move towards a thriving and fairer society and a much healthier environment. Unfortunately, we know that they often make promises that they don't fulfill, but we also do believe that there is a way. You've highlighted a practical path towards a new investment model that I call the next frontier. So how to design and manage investment portfolio in a way that's I would say, that aligns both societal and business value. Thank you so much for that. And I would like just to conclude by I like finishing with a quote, so I'd like to give a quote by Gandhi, who says basically your actions become your habits become your values become your destiny. And I think it's true at all levels. It's true at the personal level, it's true at the company level, and it's true at the investment level. So yeah, just so it's a nice quote to finish our discussion.
Thank you, Nadia, for the time. It was.
Thank you, Gavin.
Thank you so much, Gavin and Nadia. We really appreciated the opportunity to learn more about some practical ways that others can lead in this space. Next, I would like to invite one of our Oxford MBA students to the stage. Lorenzo Capinpin is not only an Oxford MBA student, but also a former industry business architect with SAP. And I think you are really going to enjoy his reflections and provocations on today's themes. Welcome to the stage, Lorenzo.
Thank you, Amanda. Okay, let's start with a little thought experiment. Have you ever looked at your phone, and yeah, you can look right now, I don't mind, and wondered why the icon for your Notes app looks like a paper notepad, even if you don't take notes on your phone the way you would on a piece of paper? It's a small and often unnoticed design choice for many things in the digital world, to use and reference things that are familiar to us when the technology itself is new or unfamiliar. We call these skeuomorphs, a term with origins in ancient Greece. And though writing with a pen is essential to notes on paper, it's very different than writing or taking notes on your phone. I'm Lorenzo Capinpin, and I'm an Oxford MBA student and former business architect at SAP. While I'm not an expert in ancient Greek, I do have stories to share on how companies can use technology to drive systemic transformation. Today, through two stories, I'll be talking about reframing, one simple but powerful tool to see familiar issues in a new way and maybe find new solutions to address them. In my experience in working with companies around Asia, I've seen the potential of emerging technologies such as blockchain to improve public health in rural areas, while I've also seen how the inability to distinguish new things from old in another industry can hold back better outcomes for farmers and agricultural products. But before we get into that, so far in the forum, we've heard our speakers talk about the role of purpose in driving company performance, the courage required to lead multi-stakeholder partnerships, and playing the infinite game instead of simply looking at the scoreboard. We also heard of the role that technology plays in this transformation, a role I'll be exploring further in talking about blockchain. Now you may be wondering, what does blockchain have to do with systemic transformation? A pharmaceutical company I was working with also wondered the same thing. For years, we had explored the potential of distributed ledger technology. And for years, we could never quite come up with a business case. However, when we stopped to look at what keeping the status quo might actually look like for the company, we realized that the issue with the business case wasn't the economics of it, but rather our frame of reference. In other words, we were thinking in terms of pen and paper when what we had in front of us was a smartphone. Instead of viewing blockchain as a solution to a supply chain problem, we began to ask, what could be possible with a tamper-proof record of pharmaceuticals? Then the pieces started to come together. According to the World Health Organization, 1 in 10 pharmaceutical products in developing countries are either substandard or falsified. Globally, the trade of fake drugs is worth up to $4.4 billion, according to the OECD. To make things worse, the most affected products are life-saving drugs such as antibiotics and antimalarials. And it's estimated that almost all of these substandard or fake drugs actively harm the person consuming them. It dawned on us that instead of a supply chain issue, what we had was a public health issue, a problem that affected everyone in the pharmaceutical industry. And by reframing the problem, coming up with a reason to do this was straightforward. This is the real power of reframing. By asking the fundamental what if questions, we moved away from what's wrong to what could be. It was the beginning of seeing the bigger picture, the broader system. In hindsight, it seemed almost easy, but we each had our own concerns. The need to manage a revenue target, the need to fulfill customer orders and move inventory, the need to generate a return for shareholders. Reframing isn't about ignoring these concerns. Rather, it's about seeing these road signs while being mindful of the journey ahead. So, we did the blockchain project and developed a system that could allow pharmacists or consumers to scan their pharmaceutical goods and instantly see whether the stringent controls of the industry were applied to the pill they were about to take. The results were incredible, but something was still off. Frankly, we needed to scale. I want you to picture this. A person living in a rural area of Vietnam may need to consume a product whose chemicals originated in India, shipped to Indonesia to be turned into a paracetamol, exported to Vietnam, and brought from a warehouse by truck, driving on rough roads just to reach a local pharmacy or community health center. Along that journey are many points where fake drugs can enter into the supply chain. The company we worked with was a large and important player in the supply chain. But to solve the problem of fake drugs, we needed other stakeholders to get involved. Governments, ministries of health, the media, other firms in the industry, suppliers, distributors, hospitals, the public health ecosystem, on and on. And though it hurt our ego, we probably needed other tech companies too. Now, I'd love to tell you that it all worked out, that everyone got on board and the problem was solved. But in reality, we had a lot of challenges, many of which are still being discussed and debated long after I and several others had moved on. There was the pandemic, the politics, and of course, those road signs I mentioned earlier. How will this make money? Who actually owns this blockchain and why? And of course, the one I heard the most often, what's in it for me? All of these questions are valid, but they're also frustrating. I mean, we did it. We built the thing. We made something that could help a lot of people. We did the reframing thing, right? But in my view, perhaps what we didn't do enough was clarify what our North Star was, what we would be willing to compromise, and more importantly, not compromise for that North Star. Reframing helps us avoid getting tunnel vision, but it's important to not lose focus along the way. The second story I want to share is about an FMCG company who wanted to give tea consumers a provenance guarantee for the products that they sold. Here I saw the power of reframing again, but in a different way. By this point in the story, we had already developed the blockchain for pharmaceuticals, and my team and I were excited to try and replicate this use case in as many scenarios and situations as possible. We were optimistic. We had the case study, we had the reframing approach, and most importantly, we had the understanding that this too would be a journey of trying to rally together different stakeholders with different priorities. So we set out and try and shift the paradigm. Was there a life or death situation here? How big is this problem? What would happen if we keep the status quo? Unlike the last time, we could never agree on what problem we were trying to solve, and the project didn't push through. The company's interests and incentives were different from those of the tea farmers, the middlemen, the cooperatives, and the different trade and consortium groups. This multi-stakeholder landscape should have been ideal for a digital record such as blockchain. But the more that we pushed, the more the broader system pushed back. Certainly, there were many people in my organization who were surprised and disappointed. After all, if we had a solution that worked, why couldn't we make it work again? I realized that that exact phrase, "it worked before, why isn't it working now?" was exactly the mindset that I told companies was holding them back from finding real solutions. How ironic, right? Reframing isn't something you do once, then you're set. It's a process of continually reviewing the assumptions you have about the way things are and why they are. It turns out our belief that we had already found the solution was holding us back from engaging in a truly constructive way. So today I've talked about an ancient Greek word, a technology more commonly associated with cryptocurrency, and 2 attempts at changing the system with differing results. But if there's one thing I hope you take away from all of this, it's to challenge your assumptions. By reframing and challenging our assumptions, we open ourselves to new ways of looking at the world, meaningfully engaging with others, and hopefully creating a lasting impact. Thank you.
Thank you so much, Lorenzo, for that inspiring rendition and exploration of your experience, and really encouragement for us to ask powerful questions and to look at how we can reframe. We appreciate you being here. Thanks for your time. I think that sets us up really well for the next panel discussion with a number of powerhouse speakers who I think have spent a lot of their careers asking powerful questions and speaking with different stakeholders. As one of our audience participants is commenting, so much of this work requires effective conversations with a variety of stakeholders. And so I'd like to welcome to the stage our moderator for the next panel, Paul Gyra. He is the managing partner of the Thompson Family Office and also the former head of ING's Alternative Asset Management in New York. We're also joined by ERIKA, who is the Executive Managing Director and Chief Impact Officer at Pathstone, as well as Andrew ECONOMOS, who is the Group CFO for Hex Trust, as well as a former Managing Partner of JP Morgan Asset Management, and Lawrence Ford, who is the CEO of Conscious Capital, as well as the founder of Future Capital. This is going to be a really dynamic conversation, and I'll turn it over to you now, Paul.
Thanks, Amanda, and it's a real privilege to be here. I want to give a warm welcome to all those people around the world. I assume there are people participating from all time zones here, so we'll be respectful of that. But I also want to kick off in a rather unusual way. I had an opportunity to meet Lawrence as part of preparing for this panel, and he has a very insightful way to prepare us for these kind of panels. So why don't I pass over to you, Lawrence, and kick us off, and then I'll go on from there with the questions.
Thanks, Paul, and hello, everybody. Yes, so at Conscious Capital, every single phone call that we do, unless we forget, because we're human, we begin with a moment of silence. And the reason we do that is because if you think about the state of our world, and you can even take that from a perspective of ancient wisdom and indigenous wisdom and even the shaman world, when they look at the way a lot of our business world and our regular culture operates, they see us sleepwalking, going from A to B, from work to home, or school to home and school back to your dorm, and see us sleepwalking, really, truly never present. So we're always, think about it for a minute, we're always thinking about something in the future or something in the past. And so quite literally, we're not here. And so we like to start everything with all of our meetings with a moment of silence. And so I'd like you to join in with me on that, so we can all kind of be fully present to be able to listen to the messages that are coming across today. So thank you, everybody, for playing and giving that a shot, and for literally being here with us this morning. Paul, back to you.
Thanks, Lawrence. And I think we know why the Washington Post calls Lawrence the shaman of Wall Street. So very interesting background. And we'll hear more from him in those areas during their session today. But I'd like to kick off to change it up a little bit. I'd like you all to imagine that these panelists are talking to 100 million Gen Z / millennials, okay? And I would like each of our panelists to introduce themselves, in the context of their background and inspiration that they might share with those listening today? Obviously, the movement towards EOM, ESG, purpose-driven investing is becoming very profound over the last 5 years. There's a lot of engagement with the next generation in this area. So, Andrew, let me kick off and have you introduce yourselves in that context, as if you're speaking to 100 million millennials, Gen Zs at this point in time.
Hi, everybody. It's a pleasure being here as my head hovers above the Oxford courtyard. I'm in Hong Kong right now, and it's a delight to be with Paul and the rest of the panelists. And thanks for this opportunity. I would say the message that I'd like to leave from my years of investing, and it's 30 years doing so in alternatives and traditional, is that a love for humanity and justice can coexist with capitalism. And if I had to leave one message to the youth out there, I would say that, disrupt everything you can. I started off in financial services where every dollar that we invested belonged to mom and dad and auntie and uncle. And the industry has morphed now into a huge asset gathering vacuum cleaner, with less concern about building a nest egg for your mom and dad, or helping you buy a house or pay for university or any of those things. So if I had to tell you one message from my background, is disrupt this industry. It needs to be disrupted. If any of you have ever tried to read a mutual fund prospectus, or have tried to analyze your insurance policy, or pay a premium, or even cancel your cable TV bill, you realize that this whole system is not built for the underbanked, the underserved, the less fortunate, and the less educated. And as a result of it, we need to really simplify and go back to managing money for people, and producing more than just returns, but producing good for society.
Thanks, Andrew. Over to you, ERIKA.
So first of all, I applaud what Andrew is saying, and I disagree, and I agree with it for the most part. So what I should say is that fundamentally, I still think capitalism can be beautiful. I think that economics is poetry. And I think that finance can be magic if you do it right, or black magic if not so much. We've been at the not so much. We've forgotten some basic principles of capitalism. And the thing that I love the most is 30 years in Wall Street, and I am still learning so much every day. By the way, I want to apologize for my dishevelment today, because what I also learned is that my neighborhood has a terrible power grid. So I've been running around all morning trying to find a place to do the call. So forgive me. But again, I learn stuff every day. And sometimes I have no idea where I might end up. So I've spoken at Oxford on the value of ecosystem services. And that was before I even knew what it was. And I've recently had the opportunity to be at the Vatican for an initiative on human flourishing. So who knew that I would be there after my years of, finance? And what I will tell you is, I think Andrew mentioned learning wisdom from the ages. And there's one of my favorite Talmudic scholars, Heschel, Abraham Heschel. And Heschel said that every journey has a destination to which the traveler is unaware. And so I think that's beautiful. And it goes back to the idea of questions. We always need to question, and we need to define our terms, whether it's ESG or anything else. So again, I'm delighted to be here, and most importantly, hear about your questions and talk about everything from impact investing to thematics to ESG analysis. Whatever you guys want to talk about, I'm not shy. So I'm delighted to be here.
Thanks, ERIKA. And Lawrence?
Thanks, Paul. And I'm realizing I know ERIKA from before, and it's realizing what a beautiful panel Amanda has put together here with Paul. And so, yes, I completely agree with everything that everybody has said. And so let me, rather than be repetitive, let's see if I can be accretive here, which is the biggest takeaway that I have learned through my years of being in this business is that we're missing the point, and that we've made a fundamental error in our calculations on the measurement of capital. And that is, what is the greatest and highest form of capital? And a simple shift to changing the thinking and understanding and belief, and I would even say more knowing of a deeper embracement of this concept, is that each of us has a gift to give to the world. And that truly is the highest form of capital. And a magical thing happens when we can shift our perspective that way, from my point of view, and from my experience in my years. When people are living their reason for being here, their genius and their gifts, think about it for a minute. Anybody who you know, and I'm not talking about perfection because that's an illusion, but for people who are really doing what they love to do in life, it is typically their genius. And think about those people. Are they miserable or are they happy? And I think you'll find that for the most part, if not all people who are living their reason for being here are happy. And consequently, they have inner peace. And so when you have inner peace, the more people who have inner peace, the more we have world peace. And so if we can greet each person and each investment concept and each business, looking at our employees in every scope of capital and our engagement with capital with the beginning lens of what is the highest form of this capital, and it's each other's gifts, I feel we can transform the world. Now, from moving from preaching to my experience just quickly, that's not so easy to do. And I think we all know that, because there's like this great magnet that pulls us sleepwalking into the herd of general consensus and mentality. And there can be a lot of pressure there. So my biggest piece of advice, which is always dangerous giving advice, but my biggest piece of advice is knowing that you have a gift inside you that is incredibly special. If you are in the, say, business school, you are graduating from one of the most renowned business schools in the world. So you have been given the gift of this training of capital, which is nothing more than a sharp stick as a tool in the world that you can use for good or go ahead as a sleepwalker. And we've seen what that's done to the world. So have courage, believe in yourself, and don't listen to others when they tell you you can't.
Thanks, Lawrence. So let's have some fun and jump right into it. ERIKA, tell us what ESG is and what it is not, from your perspective.
Sure. Simply stated, ESG analysis is a discipline. It's an investment research discipline. That's it. All right. People like to say ESG investing. There is no such thing. Anybody who refers to ESG investing or ESG as an asset class or ESG as a theme or whatever it is, it's probably not. All it is a roadmap, a path for research. All right. So any given ES or G factor, environmental, social, or governance, any of these factors is simply a starting point for inquiry. And by the way, ESG is everything and ESG is nothing, all at the same time, right? So what you have to understand is, again, it's just the next lens for research. And if someone is not using that term, if they're a great investor, likely they are doing ESG analysis. They might not label it that. So the reason it's so problematic right now, this lack of understanding, is because it has become ideological and political and divisive, and that is that's a problem that is, it's a making of our own to some degree. So people do use it now as an ideological thing. So right now you have a pushback against the use of ESG analysis. And it's really, really unfortunate because all it is, again, is more data to use in the mosaic of investment research. By the way, I didn't say before, my heritage is as a director of research. I spent 20 plus years at big firms, Credit Suisse, UBS. At UBS, I was the head of global sector research, so it was about research, and I brought the SRI team into my realm, and I learned very quickly that SRI, values-based investing, impact investing, sustainable investing, double bottom line, triple bottom line, whatever you want to call it, it's just investing. So I have a very pragmatic heritage in that. I'm also an entrepreneur, founder of Cornerstone Capital Group. And then I sold that company to Pathstone, which is my current company. And I believe that everything has impact. All right. So whether we're talking about public equities or any other asset class, it all has impact. Whenever you move money, it's going from someplace to someplace. So the key thing to understand is this is research. All right. By the way, there's a meta study that we've done called Sacrifice Nothing. Meaning, if you use ESG analysis in your investment process, you're not going to sacrifice returns. In fact, some of the evidence says it's quite the opposite. You could have additional returns. You can get both impact, social impact, and financial returns. So just remember, it's just research. It's an analytical discipline. It is not investing in and of itself.
ERIKA, let me go back to you on one more point. Of ESG, you had mentioned you thought the G was first amongst equals. Can you drill in that a little bit more?
Sure. I don't just think that, I know that, all right? And that's from, again, years of experience. The governance issue, G, again, first among equals, because if you're a company that is conscious about the environmental issues that exist in the real world, if you are conscious about the social issues that surround you, well, that's good, right? That's important, because if you're not conscious of the E and the G, of the E and the S, then you are not well governed. It's tautological. And so when we say ESG, you don't even have to use those words. Just talk about governance. If you're operating in a water-stressed region, putting up let's say a semiconductor fab, which needs huge amounts of water to make those high-end chips, and you don't have water, you're going to lose your license to operate. You're going to send $10 billion down the toilet. If you're working in an area, if you're a mining company, and you have terrible community relations in the area that you're working, you're putting a $5 billion mining operation there, but meanwhile you lose all your workers, you're going to, again, send $5 billion down the toilet. All right. And that's aside from reputational risk. So you must look at the E and the S issues. Otherwise, there's risk, there's financial risk. And you must look at E and the S issues if you want to know how to grow, too. So it's not just, when people talk about ESG analysis and sustainable investing, it's not just about risk. All right. It's about potential return also. And I can give you plenty of examples of that.
Thanks, ERIKA. Andrew, the seasoned portfolio manager, you've been on the journey of managing large international portfolios. And as a fiduciary, we are always challenged with 3 Ps, right? The people, the process, and ultimately the performance. In many cases, sometimes performance outweighs the other activities at all costs. Kind of explain to the group here about how you would incorporate something like EOM, looking at social, human, natural, and financial capitalism, or ESG related kind of metrics into the investment process.
Yeah, I mean, let me agree with ERIKA on the governance part. Having prowled the emerging markets in Asia in particular for so many years, we see a serious lack of governance. It's improving, by the way, and we're getting better management teams and more professional, but that's been a big issue for us. And as a matter of fact, we've done research ourselves here and found that the companies that were the best governed or the best managed, and those that had independent boards and were focused on society as well as their returns, produced better returns for investors, and had better financial numbers in general. So I think the governance piece is critical for us. We try to incorporate it now that I'm in the venture capital world. I try to incorporate it in the due diligence part of this. And like you said, Paul, we're so focused on performance now as both investors as well as limited partners or management teams. And we've kind of lost the people and the process part of it. So we try to focus on the human capital first, making sure that we have the right people in place and focused on the right objectives. We then obviously look at the social part of it, which we think is critical. What are they contributing to society? What are the outcomes? What are they doing for the planet in general? On the natural side, how are they using these resources? And finally, financially, how are they managing those and allocating that capital? And over time, is there a pattern of management doing what they said they were going to do with that capital? So we bring it in very early in the due diligence process. We monitor our companies as investors on the back of their adherence to social responsible investing, or I should say social responsibility. And as a result of it, we tend to create what we think are going to be the next generation of socially responsible companies. So do it early, do it systematically. Put it under the microscope, especially when times are good, and then focus management on other aspects besides, their financial numbers.
Thanks, Andrew. I'm going to switch back to Lawrence. Lawrence, you're very much involved in the RIA community, the mass affluent, the broader qualified, unqualified investors. Kind of explore with us what you're doing in conscious capital in terms of using the use of blockchain and technology and new types of activities that you think might shape the future of investing that could actually lend itself towards this vision of purpose-driven investing.
Yeah, thanks, Paul. And that's great because this gives me a chance to come in from the angle from the investor out. And it's a really interesting and challenging journey, as ERIKA has been putting so nicely as it relates to the lack of perfection in the science of the measurements and the data of measuring the tools around the environmental, social governance, or even other aspects. It's difficult from a due diligence point of view, as Andrew was talking about, to really get those factors in place, which is why it's always, I agree, so important to start with the human capital and the governance, which drives which is driven from the human capital culture. From an investor point of view, we're doing some really exciting things at Conscious Capital and a company we just launched called SIOS, which is going to be entering into the tokenization of utility NFT space. Because quite frankly, we see this as a huge opportunity to be able to democratize access to investments that clients have not been able to get to before. And not only that, but obviously increase the efficiency to a market that is in, let's see how I say this politely, in a great need of revolution. So from an investor point of view, what we do is we first start with the ability to look at our clients as I said earlier, their most valuable form of capital, which is their gifts. So we have a very fundamental belief that is beyond basic needs. Money is useless unless it's supporting your purpose and your reason for being here. So we start from that holistic approach, and our advisors in our offices with family offices and individuals to help understand not only their values, as we've been talking about, but their internal values of what they want to express in the world. And by the way, excuse me, I have a little bit of an allergy here, so my voice is a little off today. So that's where we begin, and we express that through their asset allocation and portfolio construction based on what their needs are in order to be able to achieve those goals from a practical return on investments, and then build out a diversified portfolio that aligns with their values. This is where it gets challenging. It's easy to talk about it, but to actually execute this at scale has been part of my passion over the last 10 or 12 years in building this next generation. So in the public markets, I think the thing to take away here from that perspective is that there are inherent limitations from the lack of ability to get good data. A lot of the important data from the governance and human side, although there's been great work done, is still qualitative and unperfect is probably the best way to put it. But we can get a lot done in evaluating through the tools that ERIKA was mentioning and beyond, including the environmental, the SDGs, the Sustainable Development Goals, which 183 countries agreed on, which is pretty amazing thing. So we can use that as a positive proxy, as we do for evaluating values. And then applying those to a portfolio in the public markets, but then moving into the private markets and being able to get much more intentional with investments in that space. As it relates to the conversation around the blockchain and the tokenization, I will just say that the ability to be able to crowdfund, to be able to bypass the old boys and girls network of the private equity side to really to be able to democratize access for everyday people is absolutely extraordinary. And as I think I might have mentioned before, 10% of global GDP, which is a number I don't think anybody has the real stats on, but just even if it comes close to that, is what it's supposed to be by 2030 in the blockchain world. So it's a huge revolution that's happening, and everybody should pay attention to that. And we are very excited on our side to move into a fiduciary position in doing this in a regulatory proper way that can help move trillions of dollars for good in the world.
Thanks, Lawrence. Let me drill a little bit further on that point. We see the advent in the last several years of NFTs, the movement of communities, the power of communities, aligned interest through technology. Do you think this is going to have a huge impact on the way people come together to invest and have a voice that they never had before, not just domestically, but globally?
Yeah, I mean, without a doubt, Paul. And I know that you're from our conversation one-on-one, I know you're deeply engaged in this space as well. And I'm sure we could have a panel on this that would go for a day. So I'm kind of at a loss of where to start other than a big yes. It is something that done properly can and will transform the ability for individuals to not only invest in things intentionally that they care about deeply, but have access to things that they haven't had access to before. Let me give you a kind of a little bit of perhaps a far out example, but to take you maybe through a little bit of a use case. So let's pretend that you're excited about certain movies, and a movie producer, maybe a movie producer like an Avatar, right? That you feel has a message deep inside of it and has a purpose. Typically in that world, what happens today is it follows the typical capital raise of the industry. Imagine now for a minute, and by the way, during that life cycle of the private equity raise through the Hollywood and media world, as using as one use case and example, the content creator, the person who actually created the content, is one who is usually left behind and gets a very small piece of the pie. So it's entirely backwards as much of our system is. So imagine for a minute that this producer decides now, and content creator decides now to go out to their fan base and provide them the ability to participate in this new production. Let's say, for argument's sake, they're able to raise 40% of the raise and then go out to the traditional markets afterwards. What that does is two things. Number one is it gives the content producer the ability to now control rather than be controlled by a market, and be able to express their gifts more into the world. And think about it from an investor point of view. You know, if it's done in a fiduciary responsible way, so someone isn't putting their life savings into a movie production, but it's working through a registered investment advisory firm or advisor, or a process that governs that percentage of allocation that would be appropriate for that individual, they get engaged, they get to be passionately part of something they like. Then things like utility NFTs can be a wallet, a conscious wallet that holds not only their certificate, like a stock certificate, but also dynamic communication tool back and forth, which gives them access to certain things based on their investments, and all sorts of individual engagements and passion. Now you can take that across all sorts of things that your mind can create about how we can change the world and get engaged individually on things that you're passionate about and where you want to participate. Normally, you have not been able to participate before unless you're the ultra wealthy.
Yeah, I mean, Paul, if I can add to that,
Sure.
where it gets really interesting that we found is obviously with this the tokenomics around gamification and game finances, or GameFi as we call it. We're able to have kids in lesser developed countries in the emerging markets play games, earn tokens, and in effect pull themselves out of poverty via doing things that they love. And I think that's going to be very interesting to continue to follow, using these tokens that come from play to earn type games as those develop and get much more advanced. So there's this opportunity to do what you love, and earn as you do that, and it leads to obviously pulling a lot of young people out of poverty, which we think is exciting. And of course, there's also the data issue that now with Web3, you have the ability as the user to control your own data, to decide whether or not to monetize it, and decide whether or not it's going to be used by others for their purposes. So it gets really interesting, and all of that, I think, ties in quite nicely to the economics of mutuality, which is, you know, controlling, building virtual economies for social good, as well as the fact that you control your own data. That again is part of the governance piece.
Andrew, great example. And if I may just come back with one other piece on that, you know, and then you can take that to scale, exactly what Andrew's talking about. And when you move into the institutional space, you know, we're starting to talk to, like, you know, $500 million climate funds, which are investing in early and mid stage catalytic changing investments, and people doing incredible things and moving into that world and helping those funds tokenize those offerings to make them much more efficient and provide the sort of communications and expansion of the passion that Andrew's you know, explaining in the gamification side. It's really exciting time.
If I may add, the funds that we're talking about are going to be way more than $500 million. We are talking about very large funds now at scale. And I just want to say that what you guys are talking about is beautiful. And that's the future that I mentioned when it comes to Heschel, this journey. So we don't know where it's going to end up, but we know it can be beautiful. And, you know, it reminds me again, I am very, you know, I love the idea or the reality of thematic investment. And so as long as we're on the subject of technology and how do you use it in a constructive way, we also have to use it in a future thinking way. And so these funds that we look at, and by the way, so Pathstone advises on about $75 billion in client assets. So we are an RIA, and it's families and foundations. And when you think about where we're going, it actually helps us select managers, right? Because we want managers that are forward thinking. And so as another example in technology, I mean, I think you guys mentioned the movie Avatar, right? So one of my favorite movies is called Everything Everywhere All at the Same Time, right? And I wouldn't know what that was about unless I had done a little work on quantum computing, right? Superposition. And so when you think about quantum computing and you look into the future, think about the impact of quantum computing on those sustainable development goals, on carbon emissions. When we understand their shipping and airline and railroads, the logistics associated with the economy that's carbon intensive, well, we get those logistics right, and we're going to drive down carbon emissions dramatically, right? So that's quantum computing and the sustainable development goals. And by the way, on those 17 SDGs, I want to be practical. In and of themselves, they are uninvestable. You can't just say, okay, I'm going to invest in no poverty, right? I'm going to invest in life below the seas. In and of themselves, you got to figure out how to get to them. So a number of you have used the term, my favorite term, access. It is all about access. When we talk about the interrelationship of the SDGs, you can't get any given SDG unless you look at the interrelationships, the intersectionality, and the one single common denominator among the SDGs is access, right? So if you want access to SDG number 5, women's economic empowerment, well, you got to get access to water and healthcare and broadband and capital. And so you have to think about those interrelationships. So one of the ways we figure out how to kind of eliminate or identify greenwashing is if a company or a manager says, I'm just going after SDG number 5, so I'm going to count the number of women on the executive committees. Wrong in so many ways, because it's so, narrows it down to one thing as if it's on its own. The SDGs, the ESGs, they're all completely interrelated. And so access as the single common denominator to me is really, really interesting. And so there's a framework called the Access Impact Framework. And we take those SDGs and bring them down to access across sectors and industries and companies and managers. And you try to look at a client's portfolio in the context of what access they want to go for. And then what exposures in other SDGs do they have with managers? And how can we see really what we should do with that one asset allocation, and then the various investments across managers and across asset classes. So there's so much going on, and it's so exciting. And so when I say that capitalism can be beautiful, it is still the best system the world has ever known for creating prosperity, right? It's just messed up. So we have to fix it, and we can. And so it's all about access. It's all about the future. It's all about that journey that I talked about, constant learning. And I'll tell you another quote from that favorite, wisdom of the ages from Heschel is, "We hope that you live life in radical amazement." That's so cool. So, sorry, I went off on a tangent. Sorry. Back to you guys.
And ERIKA, that's fantastic. Let's drill a little bit further with you too. You have a fascinating perch being part of a multifamily office group. And I think many of us would agree that early movers towards impact investing, whatever you call it, was driven by, stewardship of families, their companies, their values, and want to express their values by finding new ways of investment. And we start to not only expect, they require, and they don't require less of a return, they actually require more of a return because they can influence it, because they know how to run businesses and they have domain expertise in that area. Can you share with the audience here, what you see coming out of that family office community in terms of themes, ideas, what they're chatting to you about as, this next generation thinks about allocation of capital from those groups?
Well, it's very interesting. And by the way, it's not equivalent across families. All right. So if you have $1 billion family and there's multi-generations, you might have Gen 1 that is very conservative and traditional and completely separates their investing with their philanthropy. All right. We would argue that there is a continuum there. All right. Your philanthropy can become impact investment, or your entire portfolio could become sustainable investing, as we call it, which is just, the systematic integration of those material ESG factors that we talked about. So the truth is, it's a very broad spectrum of families. And again, you might have that first gen, very conservative, whereas the third gen is all about impact, insists on impact. So, you can bring those together. You can do different, carve outs for Gen 3. But what we try to do is, again, bring them together around values, around purpose, around the fact that, there's some education to do, right? Because ESG integration, all right, is absolutely not against fiduciary duty, right? We are fiduciaries. So it is, in fact, in my view, it is critical to fiduciary duty if you're doing good analysis, robust analysis. But there still are these myths, all right? The myth that you're giving up returns, the myth that there's a fiduciary breach. So we have to get over those myths. And as we do, you can bring Gen 1 along, but you might not be able to. And so it is a matter of time. But I will tell you that, yes, private wealth, it has been among a leader. The truth is, another leader in impact, maybe even more so, has been the nuns, the religious community. And it is about principles. And by the way, across religions, whether it's Judaism or Catholicism, all the Islam, there are similarities in terms of principle and how investments can be made. So the reason I throw all that in there is because you can't make generalizations. Many of you have heard the term, if you've met one family, you've met one family. And so, yes, there have been leaders, but you'd be surprised. They're all over the map.
Thanks. ERIKA, just one last, maybe I'll switch over to Andrew. You're in a part of the world, billion people in Asia, billion people in India. You're in the tech business, VC business, gaming business. Give the audience here some insight of the degree in which those communities could impact change for the planet and people.
Yeah, I mean, it's first of all, it's a pretty broad spectrum, right? You've got fairly primitive economies, and you've got some very super advanced, very modern ones. So it's hard to draw generalizations. But I will say that what we're seeing in this next generation of companies that are coming up in Asia are technologically advanced, but also are highly socially aware. We're very pleased with the quality of the young managers that we're finding in these startups. They're not just about making great returns for investors or making money for themselves, but rather there is social good built into what they're after. And their objectives and their goals and their vision for their companies. And they're using technology to go about it. And as we talked about earlier, it not only democratizes, or should we say carefully, socializes change in industries, but it also brings about remarkable speed in terms of evolution from old school traditional industrial type economies now to more advanced information-based. And I think that's where the real excitement is for us, and the ability to see these companies move very quickly and leapfrog one generation of technology and really leapfrog old practices. And like I said, with a very strong vision of their responsibility, or a very strong sense of their responsibility to society. I mean, as a matter of fact, I was surprised even the industry, and VC is venture capital is not known for its collaboration. It's fairly secretive, but 120 venture capitalists got together and collaborated and developed Impact VC, which is the playbook that they are using to measure, monitor, report, and develop best practices. And we've been applying that here in Asia in terms of investments. And what's remarkable about this is not just 120 venture capitalists coming together, but capital firms, but rather the fact that it's specialists and generalists really, deciding that they have to be socially responsible in the way that they choose their companies and the way that they monitor their companies as these companies grow.
Great. Thanks, Andrew. Hey, Lawrence, I want to swing back to you because you're a prolific speaker at a lot of esteemed business schools like Saïd Business School, where they're trying to introduce the case studies, not just around bottom line about cutthroat capitalism, but more inclusive capitalism. Let's take that a step back a bit about financial literacy in general. How do we educate and train the youth about the whole paradigm of finance and investment and the power of what I call complete capitalism, social, human, natural, and financial capitalism? So it's not learning about this at business school. It's learning about this as you go through the journey of life and finding purpose in your interaction with your parents, the businesses they work for, the communities, the capital markets. Give us some of your insight of what you think will be happening in the future in that area of financial literacy.
Wow. Okay. So there's a big question there. We don't have a lot of time. I think. So yes, I do get the gift of speaking to a lot of top business schools, and the reason I love that is because they are our next stewards of this nexus between consciousness and capital. Now, this capital is just this external tool, and as ERIKA puts it, it's a beautiful, lovely tool that can be either leveraged for good or for bad. And when we're conscious about how we leverage it, it can do amazing things. When we sleepwalk, like I started this panel with, then we find ourselves in situations that we could be heading today, which are not the best trajectory of our species. I know the audience has heard a lot of stuff. There's been great speakers. Maybe I'll tell a little story that will pronounce a little bit about really getting to the systems-based thinking of the underlying causes of what business is about and what to focus on. So I think it was maybe, I don't know, I'm going to guess maybe 15 years ago, maybe 20 years ago, something like this. I used to play racquetball with an associate of mine, and he was a top CEO of a major company. And yeah, I think it was about 20 years ago. And one time we were sitting outside as a break in between one of the games, just chatting. And we're sitting there with our rackets in our lap and full sweat going on. And we had become pretty close. This gentleman knew me really well. He would show up every game in a different car. He was extremely financially wealthy. And I had not reached the level of financial wellness that he had. And he had it in his heart for me to make that goal, which was not my primary objective. So in a moment of frustration, he said to me, he goes, you know what's wrong with you? And I said, no, what's wrong with me? And I'll withhold his name, of course. And he said, you don't get it. It's just a game. You take this too seriously. So if you really take that conversation deep into your heart, you'll start to understand the old problem of capitalism from my perspective, which is it has been a game. It's been an old boys game filled with way too much testosterone, greed, obfuscation, and bullying of getting ahead of everybody else, and not only not paying attention to externalities of the human damage and the material and spiritual damage that it's causing in the world, but using it as a game and as a measurement of a game of financial wealth. So my message, so I think the thing I'd really like to leave with everybody is use that same power of this beautiful tool and drive with purpose and meaning and your own gifts. And those things, as you've heard today, are all things that we have begun to measure from many different quantitative and qualitative aspects to start to prove out that it's actually a better way to do business, and it sustains better and you actually profit better. So that's where I would put your focus. I would make sure that you're always checking in with yourself. Are you getting pulled by the great magnet of the old herd into a herd-like behavior where you temporarily feel safe by being in the middle of the pack, but not heading towards your passions and not measuring and performing in things that you know matter in the world? Because, and I want to say this final thing. One of the things that happens, as Andrew was talking about, the world is waking up. When you wake up and you realize, you really truly realize the gift of being here on this earth. Now, we've got 70,000 or so cells working in harmony inside our body at every single moment, keeping us here, slowly reversing entropy for a while we spin around on this globe. And the gift it is to be here at this time, and the gift we all have to have that awareness as well as the skills and tools of business is quite unique and quite important at this time where we all come together and compete together and stop competing against each other, because I see this as a critical time of being able to either destroy our species with the huge risks of artificial intelligence, things like desktop CRISPR, all sorts of external threats that we haven't seen before that can eliminate our entire species, or, as Buckminster Fuller would say, use that trim tab of shift of consciousness and move us in a whole new trajectory as a species.
All right, so I just have to say, now I love Lawrence even more than I did before. That is so great what you just said, and it reminds me, purpose. I mean, there's a book called The Purpose Economy. Purpose is, I think, what can lead you to being, content, right? And so this guy who said it's just a game, I mean, I want to punch him in the face. It's not just a game to people that can't find housing or make a living. It's not just a game, right? And so I was just thinking, my youngest daughter, I like being proud of what I do, even though I've been in finance for 30 years. I am really proud of what I do. And so my youngest daughter, you try to explain to kids about finance, about money, it's important. And if you were to ask her, this is a few years back when she was little, what does mama do? What does your mother do for a living? And she would say, well, mama is a stockbroker that helps save the polar bears. I love it. I absolutely, thank God that I have, pride in what I do, and purpose and respect and giving a damn about other people. I mean, that's where it's at, and I feel so proud of, the work that I've been allowed to do. So Lawrence, bravo.
Thanks. Amanda, I'm not sure if it's to the top of the hour. Should we take a few questions or continue on with
Yes.
more from the audience?
I think it would be great if we can take a few questions. I've got 5 of them queued up, so I'll start sending them over to you. Folks are really enjoying the conversation. So here's the first one, Paul.
Okay. The first question, where can we access the comparison data that reinforces that investors sacrifice nothing?
Easy.
In book, over to you,
sorry.
ERIKA.
Well,
ERIKA?
A few weeks ago, Pathstone published a report called Sacrifice Nothing. All right. And it looks at, a history of like 1,500 studies. It's a little meta study that basically shows the reality. So if you go to pathstone.com, it should be right up there on our research, or just Google Pathstone Sacrifice Nothing and you'll see it. So it's a kind of, it's table stakes to some degree for sustainable investing.
And a quick shout out to my buddy Raj Sisodia, who was part of writing that Firms of Endearment book, which was one of the leading shakeups in this world.
Okay. Another question, Amanda?
Do you see Raquel's question on the bottom of the screen there?
Any advice on modeling and messaging, not just to the social compliance, but across the company, that we do not want to do business at the expense of people's dignity?
Well, I think that's the beauty of capitalism, right? You vote with your feet. If there's companies that are, impinging on human dignity, then you're not going to invest in them. And as a matter of fact, you may even be activists and try to take over the company and remove management. So that's the purity, I think, of capitalism, that you can either put skin in the game or not. And management can be changed and employees can be fired.
Can I just want to extend, actually, on this note, an invitation. Because again, active ownership, all right, corporate engagement, in my view, that is so critical to the asset management function. It is so critical that asset owners understand active ownership. So an invitation tomorrow at 2 p.m. Eastern time. I'm going to do a little webinar with two really interesting active asset managers, all right? One of them you may know, it's engine number one, who got Exxon to change their board. The other is called DSC Meridian. And then I've also invited the CEO of As You Sow, which is about, voting your proxies, making resolutions. So again, if anyone wants to join, I can get you the details of the webinar. It's probably also on our website. But this is hugely important. We cannot abrogate our responsibility as stewards of capital. So again, 2 o'clock Eastern tomorrow, you're welcome to join.
Thanks. Another question from Anne Florini. Can tools like blockchain apply to government flows as well? The U.S. Inflation Reduction Act is supposed to move tens of billions of dollars into marginalized communities. Could those communities use these tools to exert community control?
Yeah, I mean, there's a series of layer one blockchains that have come out that that are all about community good. So what happens is you will you use the tokens. I think the company one in particular is called Canto. Use the tokens and you vote those tokens as a community to provide a social good. It could be improving ERIKA's electric grid. It could be, putting in fresh water. It could be, again, pulling pollution out of streams and waterways. So this is something that we could use. The blockchain in particular can be very effective, and the tokens themselves backing a community, these DAO type organizations, where you can then vote and affect change with those particular tokens. And if you organize them in the right way, and you get enough behind in terms of assets behind the foundation, then I think they could be a tremendous vehicle for good.
Another just quick aspect of that can happen, which I don't know is happening yet, but it's an idea that I would love to see executed out there, and maybe we can help facilitate that, is from a public and private collaboration. So when there is let's say a stadium that has been decommissioned, and now a whole bunch of developers typically come in and try to figure out what to do with that. Imagine for a moment if you allow all of the community to then be early investors from a crowdfunding aspect of that, including allowing the kids to come in who do promotions and ideas around that, and really truly make it a collaborative event rather than internal negotiated development project that happens that isn't always above board.
Great. Okay, question for ERIKA. How to make access to the SDGs easier for investors?
Yeah. What I should say, doing big things, it's not like a serial cause of, events that gets it done. You have to kind of parallel process. That's how, that's why quantum computing is going to be so important. You have to do a lot of things at the same time. So explicitly, the reason we created the Access Impact Framework is to bring these SDGs down to a digestible, manageable, and investable framework. And so honestly, the idea of access, again, as the single common denominator, when you look at these SDGs, how do I do this? And so for us, again, it's through access. I honestly can't think of anything else that will work for an investor. I mean, this was why we came up with it. When you think about companies, corporates, we're trying to, sort through greenwashing. And so again, within a company, what we're trying to look at is consistency. So that's an important word also, because when a company is being inconsistent, on the one hand, they're talking about, emissions reductions and net zero. And on the other hand, they're lobbying in DC against regulation. There's a big inconsistency there. And so we can get rid of that as a possible investment, or we can engage, right? But that's company by company, all right, which is doable, and we do it, and I'm happy to engage. And we created, years ago, the SASB, the Sustainability Accounting Standards Board, so we can have standards for disclosure. But company by company, we do that. But for an investor, for an asset owner, they're not going to do that company by company work. All right. So they're going to hire asset managers to do this work for them. The asset managers work company by company. As an asset owner, we, as an advisor, we go, sector by sector, manager by manager. So it's complex, and I'm not, it's just hard things. If it were easy, anybody could do it. And when it comes to impact and sustainable investing, values aligned investing, not anyone can do it. Sorry, I don't have an easier answer. Access.
Okay. How do we connect and draw from the cultural, anthropological, historical, and justice-oriented domain expertise?
I'll make a quick comment on that. And, it's interesting. I am also the founder of Future Capital in partnership with the United Nations, where we have really wonderful initiatives we call working groups to help solve big problems and bring some of the most extraordinary people around the globe to do that. And one of the things that I'll just take you on a little quick arc. One of them is called Transformation of Business Working Group. And one of the leaders of that group is a gentleman named Graham Boyd, who's brilliant out of Berlin. And he wrote a book called Restructure, which is about that thick, which I'm sorry, Graham, I only made it halfway through the book, but it's incredibly intelligent analytics of foundational, restructuring of business. And so I've been on this long, beautiful arc working with all these beautiful people. And to answer your question is, sometimes, just coming back home to fundamentals is really where we all need to come. We tend to entertain ourselves with our brilliant minds that some of us have been gifted with this time around. And really, sometimes it's just the basics. And so one of the things that we do is we are very, very aligned with original peoples and original principles from around the globe and indigenous wisdom. And it's kind of like, I don't know if anybody ever read the old book about, I'm probably going to butcher the title, but Everything I Needed to Know I Learned in Kindergarten. Do you remember that book? If you haven't, you should check it out. It's kind of interesting. But I kind of feel the same way to that answer is, the fundamental principles about love, generosity, all my relations, right? I mean, they're there. And I think leaning back and recognizing those expressions in each culture is a good foundation for starting as we move into the capital markets in each of those areas.
Hey, ERIKA, I'm going to ask you a quick question first. You touched on the sustainability standards, right? And reporting. Could I talk about that a little bit? Because when I kind of engage with the investment community around the world, particularly the UK now, they're requiring asset managers to do ESG reporting, and there's a lot of confusion, and what are the expectations, and there might be a bit of a misnomer there between the standards and what they're trying to get at and what the reality of what the game plan is. So help me out with that a little bit.
Yeah, here's where we go to the language kind of messing up the objective, Sustainability Accounting Standards Board, the SASB. All right. We founded this. I was one of the founding board members. It's almost exactly 10 years ago. And what everyone has to remember is we're not talking about sustainability standards. We're not talking about performance. We're talking about standards for disclosure. All right. We want companies to disclose material ESG factors, material, i.e., an investor can, use this to make a decision, right? So we're looking for material ESG disclosure. So here's where right now the data, all right, underlying ESG reporting and the ratings and the rankings and the indices and the ETFs and the funds is really messed up. Now it's worse in the US, it's coming around in Europe, but the key is we want data from companies that matters, that's important material, and we want data that is comparable and data that we can make projections based upon, right? We don't have that right now. And by the way, that's a really big problem because, like I mentioned, this whole food chain of flaws is really problematic, right? Because people are investing in some index fund that's based on bad data. It's really not good. But we're starting to, get more standardization. That's good. All right. And again, in Europe, it's happening faster. The SASB has evolved. Now it's part of ISSB, a global standard. So it's happening. The problem is, though, the perception is that these are sustainability standards. They're not. All right. They are requests for disclosure. And then they can be used in a more pragmatic and sensible way. So we still have some time. We're getting better, but we're not there yet. And again, I just want to repeat, ESG factors, ESG scores and ratings, these are simply a discipline that can go into the mosaic of investment work. Okay, so really important distinctions. And again, this distinction is part of why you have this global shitstorm, in terms of the use of sustainability and factors, and it's becoming politicized and divisive and ideological. Let me tell you something. I can use ESG analysis as easily to do sustainable investing as I can to destroy the world if I choose to do that. I'll use the ESG scores and measures and matrix to destroy the world and the planet and all the animals, the species, whatever. It's just research. Okay.
Thanks. Amanda, how are we doing on time?
I think it would be fantastic to move to any kind of closing comments. This has been a fascinating conversation.
Okay, well, thank you very much. Maybe I'll just go around the horn one last time to have ERIKA, Andrew, and Lawrence give any final remarks to those 100 million millennials out there, Gen Zs, right? With maybe a nugget of inspiration or insight.
That's easy because I had mentioned a couple of quotes from, my favorite Heschel, all right? And another of Heschel's pieces of wisdom is that it is wonder rather than doubt that leads to wisdom. And so I look around and I see what's going on, all the good stuff. And that wonder is what drives me and purpose and doing what I do. So yeah, Heschel's my guy.
Thanks, ERIKA. Andrew?
I would reiterate the message of disruption. I have to admit, we've been sitting and been so complacent in capital markets and asset management and financial services. It needs to be disrupted. It needs to be made simple. It needs to be made cheaper, and it needs to be made much more effective. to meet the needs of human beings of the world. Say, continue to disrupt, make technological change, and lead this financial revolution so that it actually benefits people rather than benefits a few firms up at the top.
Okay. Lawrence?
Continue to stay awake. Know that you have gifts beyond measure. Everybody. Love everybody else and greet them with the thought of how can I lift you up and help you share your gifts to the world. And probably most importantly, play and stay light, because this stuff can get really heavy. And as we all know, nothing good comes from heavy and dark. So be lighthearted, enjoy. We have a line that I say often at our company, which is when in doubt, play. And don't forget to play.
Great. Well, I want to thank you all for your time today and your insights. And I think we've got a lot of, good feedback on that. And feel free to the audience to reach out to any of us through the EOM community and Saïd Business School. My final remarks is I ran into a guy a number of years ago who showed me this book called Completing Capitalism, Healing Businesses to Heal the World. I'm not sure that's coming up on my screen well enough, but it got me really thinking, this business community, this interaction between investment world that, oversees trillions of dollars in businesses can be the powerful tool that can impact change for generations to come and have significant impact. So I'll leave it there, Amanda, and we'll pass back to you.
Fantastic. Thank you so much to each of you. It was an amazing conversation, and I think it's a great place to leave our participants. Wonder, disruption, and play. Thank you for your time and your insights. We are now going to move to a welcome from the Dean of the Oxford University's Saïd Business School, SOUMITRA DUTTA, and he is also the former Dean of Cornell University's Business School. He also wants to invite you into this exploration. Dean?
I'm very pleased to welcome you to the 7th Annual Oxford Economics of Mutuality Forum. I joined Saïd Business School as Dean about 7.5 months ago. And I must share with you one important reason why I decided to make the choice of moving across the Atlantic to the Saïd School. As we all know, the Saïd Business School is a young school, about 25 years old. But in these 25 years, it has really blazed forward with a very innovative, impact-oriented view of looking at the world around us and rethinking business as we traditionally have known it. Now, this choice was not a random choice. It was, in fact, a deliberate choice made by the founders of the Saïd School at the inception of the school. And that was natural then because the Saïd School was born inside the University of Oxford, a unique global university with a unique global sort of set of values and a mission to do good for the world. So the last 25 years of the Saïd School, the faculty, the staff, the programs really tried to embed this whole notion of how can we do good for the world into the heart of business. How can we bring the different stakeholders together for doing good for society and good for the environment? Now, this kind of a focus in the Saïd School is not new. But of course, we know that today, 25 years later, almost all organizations and businesses are seeking this kind of a broader impact orientation. But we were pioneers in this area, and we continue to do pioneering work in our programs and in our faculty research in this area. Let me share with you some examples. If you look at our MBA curriculum, an executive MBA curriculum, there are many courses which are uniquely focused on this issue of impact and doing good for the environment and doing good for society. At the Saïd School, we have a world-famous, the Skoll Center for Social Entrepreneurship, where leading scholars and companies come together to ask the question, how can we use our different stakeholders, the strength of the different groups to do good for society? At the Saïd School MBA and EMBA curriculums, we also have unique courses such as, for example, the GO-TO program, which is the Global Opportunities and Threats program. Now, in this program, what we do is we bring together real companies who bring their real world challenges and issues, and we combine them with students who in fact come from multiple different disciplines, and we get the two groups to work together on real challenges and real issues. Now, the idea out there is to encourage students to use a systems approach to understanding and addressing complex global challenges, and to apply these skills in a global project designed to engage with systemic problems and generate robust, actionable interventions from a firm level perspective. As an example of this, the winner last year in 2022 was a group that really focused on the important challenge of how come only 1% of the global venture capital funding goes to all female founding teams, while 99% of the funding goes to all male founding teams. And this clearly is something that we need to change at the very minimum to unleash the potential that is there in half the population of the world. If you look at, for example, our faculty research, our faculty are very engaged with issues around doing good for the environment, doing good for the world. If you take, for example, our faculty colleague, Annette Mikes, she is focused along with her colleagues on a definition of what can be termed as green capitalism, in which governments and businesses really come together in a sort of both and approach as opposed to an either or approach. And the problems that we face today cannot be solved by government alone in isolation or by business alone in isolation, but really the two have to come together. And inside this agenda, Annette and her colleagues really envision a new role for the academy as a ministry by embracing pragmatic realism and inspiring everyone to create a livable future. If you look at the work of another colleague, Maria Basharov, she is looking at how to integrate an approach that combines both the internal aspects of an organization as well as external approaches to the environment and society. Traditionally, you think of ESG issues, they mainly focus on internal aspects, and traditional impact discussions focus on the impact of the company outside the organization boundaries. In her approach, she's focusing on how to create products and services that deliver positive social or environmental value, how to improve the affordability and accessibility of products and services to reach marginalized populations, how to embed social environmental considerations into a company's operation, and of course, how to use profits to support social and environmental value creation. Now, I know that you have some great colleagues out here in the forum. You'll have wonderful discussions and many stimulating sort of hours of exchanges amongst yourself. Let me just sort of leave you with 3 questions to ponder on as you go through your various discussions and exchanges. The first question is, how do we accelerate the pace of change? Now, we all know that change is required. We also know that some companies, some organizations are changing. But we know that this pace of change is, in fact, probably not fast enough, especially if you look at the pace of change in the climate. The adverse effects of climate are, in fact, happening at a faster and faster pace, much faster than what we'd anticipated 20 years ago. Similarly, digital society are also increasing at a faster pace. So how do we accelerate change is a very important question. The second important question is, how can we scale up change? Yes, we know of examples of good stories of change and a positive impact, maybe in one company, maybe in one certain part of industry in one country, or in some other localized examples. But today we know that climate change does not know any boundaries, and social issues do not also respect any boundaries. If there are problems in Africa, they'll affect Europe and far beyond. So we have to be able to scale up change to be able to solve some of the pressing issues that we all are concerned about. So second important question is, how do we scale up change? And the third one is an important one in my view is, are we in fact now today creating blind spots that we will in fact recognize only 20 or 30 years later? if you look back at the last 50 years, yes, we knew of capitalism in a certain frame of mind. We did do a lot of things good in that frame of mind, but today we know with the benefit of hindsight that we made some wrong choices that in fact created other problems. Now today we are trying to correct those problems and in fact make the right choice of the future, but are we in fact creating some other blind spots that we'll recognize only 10, 20, 30 years from now? So again, 3 questions. How can we accelerate change? How can we scale up change? And are there any potential blind spots that we should be aware of? So once again, welcome to the 7th annual Oxford Economics of Mutuality Forum. I wish you a great forum and thank you very much.
Thank you so much, Dean. Another set of powerful questions. We hope that you've enjoyed day 2 of the forum and you've begun to think even more deeply about the role you can play in accelerating the opportunity to mobilize and drive systemic transformation. We'll see you again tomorrow for our 3rd day of programming, where we're going to explore public-private partnerships and the role of international institutions. If you're interested in participating in speed networking, please find participants on the People tab on the event platform. We'll see you again tomorrow. Thanks again.